been dethroned as the top smartphone seller in China. Figures from research firm Canalys on Thursday showed it was overtaken by local rivals in 2024. Apple's market share declined to 15%, with iPhone sales down by a quarter over the final 3 months of the year. It was the firm's worst ever annual sales decline in the country and comes amid multiple headwinds. Analysts say the lack of AI on its latest models is one big factor. In the US, it offers handsets featuring so-called Apple Intelligence, but that integrates ChatGPT, which isn't approved for use in China. Competition is also steadily mounting, with Chinese brand Vivo now the market leader on a 17% share. Huawei was just behind on 16%. The firm has rapidly gained ground after returning to the high-end phone market with models powered by local chips. Meanwhile, Apple has sought to fight back with rare discounts. Earlier this month, it offered close to $70 off some iPhones bought through its own channels. Major Chinese e-commerce platforms then followed suit with price cuts of their own. Alibaba's Tmall announced discounts of up to $137. Researchers at Canalys say Apple is also making other moves, including beefing up trade-in options and expanding interest-free payment plans. But Thursday's numbers suggest the firm faces a big battle retaking the lead in one of its most important markets.
TSMC logged record quarterly profit on Thursday, with demand surging for chips used in artificial intelligence processing. While business is booming, TSMC does face headwinds from US government technology restrictions on China. And President Biden's administration this week said it would further restrict AI chip and technology exports. Though Taiwan and other close US allies will be allowed unlimited access to US AI technology, further curbs could impact demand from clients. President-elect Donald Trump's incoming administration, which has threatened broad import tariffs, also brings much uncertainty. TSMC's chief executive said on Thursday that he believes US export controls on AI chips for China were a manageable issue for the company. The world's largest contract chip maker, whose customers include Apple and Nvidia, posted a 57% jump in net income to $11.4 billion for the quarter ending December 31st. That was a record high for any quarter and in line with estimates. Revenue climbed 39% from the same period a year earlier, and it expects similar revenue growth in the current quarter of about 37% to between $25 and $25.8 billion. TSMC says it maintains its bullish outlook for AI demand. The stock closed up 3.8% on Thursday. Last year, it soared 81%.
European luxury shares soared on Thursday. Investors were excited as Cartier owner Richemont's third quarter sales beat expectations and revived optimism for the battered sector. Company shares jumped 14%. The Swiss company's sales jumped by a tenth year-on-year to $6.37 billion for the 3 months to the end of December. That was well ahead of analyst expectations for a 1% increase. Richemont said China remained challenging as third quarter sales fell 18%. But this was more than compensated for by strong growth in other regions. It said US sales benefited from customers heading to the shops after the uncertainty of the presidential election. And the strong dollar boosted tourist purchases in Europe. Richemont's performance is a relief for the sector as luxury goods companies had fallen out of favour in recent months. Investors have particularly worried over weaker high-end spending in China, the largest market. Richemont's positive update spread to rivals like LVMH and Gucci owner Kering, with their shares up around 7%. Britain's Burberry also jumped some 7%.
U.S. stocks rallied on Wednesday, with all three of Wall Street's main indexes registering their biggest daily percentage gains in more than 2 months, after the latest inflation data boosted investors' hopes of more rate cuts by the Federal Reserve. The Dow gained more than 1.6%, the S&P 500 added more than 1.8%, and the Nasdaq soared nearly 2.5%. The Labor Department's Consumer Price Index showed that underlying inflation pressures eased in December. That came on the heels of Tuesday's Producer Price Index, measuring wholesale costs, which rose less than expected. Investors are now pricing in even odds of 2 rate cuts this year. But Jay Hatfield, CEO of Infrastructure Capital Advisors, thinks there will be more.
We think the Fed will need to cut at least 3 or more times for 2 reasons. Number one, we're forecasting PCE core rolls down rapidly after the first quarter to 2.4 and then slowly goes to 2 at the end of the year. But number two, we're in a housing recession, and with rates as high as they are now, 30-year mortgages above 3, that recession is going to worsen, and that'll eventually hit employment, which will get the Fed's attention. So they don't know it yet, but they're going to have to cut 3 or 4 times this year.
The yield on the benchmark 10-year Treasury note tumbled nearly 14 basis points from a 14-month high of 4.8% hit earlier this week. Also boosting stocks Wednesday, earnings from big banks, with shares of J.P. Morgan rising about 2% on a record annual profit as markets rebounded in the fourth quarter. Shares of Wells Fargo jumped 6.7% after the bank's fourth quarter profit beat Wall Street's expectations as a surge in deal-making activity boosted its investment banking business. Shares of Citigroup shot up 6.5% after the bank's earnings report showed it swung to a profit in the fourth quarter. And shares of Goldman Sachs jumped 6%, following the investment bank's best quarterly profit since the third quarter of 2021.